Happy Friday, Brian Manning here with your weekly update. So stoked to be back. So I missed two of these. Last week I was on vacation with Amber in Costa Rica. A past client of ours, Jason Bateman, coordinated a trip for us. It was absolutely incredible. Costa Rica is phenomenal. The people were so nice. It was just a really wonderful vacation to get back to the tropics, to go from rainforest to cloud forest to Caribbean. And then the week before that, Ash was on vacation. That's our marketing person, and I can't do these videos without her because I would just mess them up completely. So I'm super stoked to be back. We got so much to talk about this week. So Monday this week, we got information from Black Knight. Actually, I just want to do a quick screen share with you. So Black Knight gives us feedback on housing and home appreciation. So Black Knight said in the month of June that homes were up 0.7%. You know, if you think back to Q4 of last year, there was so much media about the housing market, how bad it was going to be, and we're going to see a crash, and it's like 2007, 2008 all over again. But here we are. Look at every single major reporting service: Case-Shiller, FHFA, CoreLogic, Black Knight, Zillow. You know, Q4 into Q1, right in the beginning, was probably the low of real estate. Then we've seen a really good rebound because there's just a complete imbalance of supply and demand. There's definitely still a lack of inventory. So across the board, you know, you've had Case-Shiller up month over month, February, March, April, May. FHFA looks at homes across the country only with conventional mortgages. Every single month this year, April, May, up 0.7%. That's incredible appreciation. CoreLogic after January, again, 0.8, 1.6, 1.2, 0.9, 0.5%. Black Knight for June came up 0.7%. Zillow said June was up 1.4%. So across the board, real estate is resilient. It's a great place to invest money. If you want to talk more with me about this, please let me know. I'd love to connect with you on that. Also, we had some Fed presidents speaking. You know, it's interesting to see the disconnect in Federal Reserve presidents. We had Fed Governor Michelle Bowman saying we need multiple rate hikes, and she just doesn't think enough work has been done. Then you had Fed Philly President Patrick Hawker saying we don't need any additional rate hikes. So I don't know. It's all over the place. It's really hard to see what they're going to do. What's interesting, though, is that the Federal Reserve, with our taxpayer money, hire 400 economists to give them feedback of what's going on and what they should do. Mostly the majority of the economists are leading them in the right direction, and really the direction we are, but they seem to make their own decisions, which is really hard to say. And, you know, mortgage rates have been stubborn with this, with coming down because they're trying to find a direction of what the Federal Reserve is going to do, and there's just kind of a lack of direction right now. Tuesday this week, we had the European Central Bank give us some information on inflation, and inflation in the ECB dropped unexpectedly lower. So inflation around the world is definitely globally tied. So when you start to see inflation easing in the US, ECB, European Union, China, et cetera, that's really good. That's going to help us going forward with mortgage rates. Wednesday this week, we got some feedback from ZipRecruiter. So ZipRecruiter tracks hiring across the country. They said they see a lot less demand coming into Q3. They see less job openings. This is kind of in line with what we're seeing as well as far as unemployment is concerned. It's still really startling to see what's happening with the employment reports, what we got last week from the BLS and ADP. But if you look at the employment reports last week, there was a lot of part-time employment taking place. So we really like to follow trends like ZipRecruiter because they're giving us direct feedback on job postings. Also, we got some feedback on credit card debt across the country. In Q2 alone, credit card debt was up $45 billion. Right now, across the country, credit card debt hit an all-time high at $1 trillion. So if you're in a position where you have credit card debt and you want to look at refinancing to pay it off, I know you might think right now, oh, I have an interest rate of 3%. It's not worth me refinancing. It actually very well could be. Just reach out to me. We can do a debt consolidation calculator, and I can talk with you about that. Today, really important was we got the CPI report. Actually, Thursday, we got the CPI report. This stands for the Consumer Price Index. Let's take a look at this real quick because this is really important. So CPI is a gauge of inflation, and inflation is the arch enemy of interest rates. As inflation comes down, mortgage rates will come down. What I first want to look at is Federal Reserve forecast of inflation over the next several years. And this is specifically looking at the shelter model. So this shows us that year-over-year forecasts or this shelter are going to keep coming down. We know shelter, we've talked about this in the past, is a very high percentage of inflationary reading. So as you continue to see shelter come down, that's going to be very beneficial for us. But as far as the inflation reading is concerned, it was actually better than expected. The headline number went from 3% to 3.2. Actually, we were thinking it would go up to like 3.3 or 3.4. And the core number went from 4.8 to 4.7. So really good to see a better than expected inflation report. So really paying a close attention to this, we had used cars that were down 1.3%. Thank goodness. The used car market could not stay where it was in the beginning of the year. Used car prices were still going up. It's good to see on a year-over-year basis, used car prices come down. Used cars are not typically an asset. It's not usually where you see an increase of value. And then what was really surprising was that gasoline and food were not as impactful in this report as we thought they would be. Right? When you go to the pump right now, you see gas prices have gone up. We really thought by now, or in this report, we'd see a translation into the CPI, but we haven't. And that was really good to see. That was actually very helpful for us. And then food prices, which have gone up, we've started to see some increases in food prices as well. That didn't translate into this report also. Most importantly here was the shelter cost. So shelter makes up 43.6% of this reading, and shelter was only up 0.4%. So shelter went from 7.8% down to 7.7%. And we know in real life, if you go rent a place right now, that it costs less to rent a place right now, or the amount that the rentals are going up on a year-over-year basis is much lower now than it was a year ago. So really good to see the shelter costs coming down there. So this just shows us what shelter costs are going to do going forward. And if we look at last year, in August of last year into September, October, November, December, January, February, the shelter costs were really high. And if we look at this year, we've only been going up around 0.4% in shelter costs. So going forward, looking at what this inflationary report is going to do when we get data in the month of September, which is really the report for the month of August, probably the August number is going to be replacing a high August number here. September is going to replace a high number here. So with this making up 43.6% of the inflationary report, when we continue to see the easing in shelter costs and a lower number here replacing higher numbers over there, it's going to be a huge benefit for us, and it's going to be very impactful for mortgage rates, which we're super excited about. I'm around all weekend. If you have any questions, let me know. If you want to learn how we're closing purchase transactions in 10 days, call me. Happy Friday. Have a great day.